Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic I want to discuss with you Ed Slott retirement life insurance. And Ed Slott is somebody who is a world-renowned tax advisor, and he's figured out a couple different ways to leverage cash value life insurance policies for supplemental of retirement income or for max retirement income at a later date. So what Ed Slott constantly talks about is the tax advantages of cash value, allowing the money within that cash value to grow tax free and that's very sloppy. So you have tax free growth. The amount of money that you would leave to your beneficiaries would be a tax-free death benefit. And then also, after your accumulation is complete and you're ready to start taking distributions from that cash value, how to pull it out tax-free. So just to give you a little snapshot on how a life insurance policy works, is you have an individual that's paying premium dollars into a plan. So kind of think of that plan like a little egg. The dollars that are going into this, remember, it has to give you some death benefit because that's the whole sole purpose of life insurance, is to provide a death benefit to beneficiaries. So an individual is paying dollars into a plan primarily for that death benefit purpose. So majority of plans are set up that their expenses, their different death benefit or their different life insurance fees and expenses are going to make up majority of what's going into, is what's being used for that premium. And then a smaller portion is going to be going to cash value. So that cash value, you need to think of that kind of like a savings account. So if you have cash value, if we don't talk about the expenses real quick, because I want to show you different ways on how to strip out those expenses and make sure that you're really maximizing this plan. If we're just honing in on cash value, the way that this cash value grows every single year is the difference between what is being paid into that policy on either a monthly basis, an annual basis, whatever, however that individual is paying into those premiums, whatever is getting charged for those expenses is making up a large portion of that premium payment. And then that secondary, whatever's left over, is going into that cash value bucket. So the way that this bucket's going to grow is obviously the net difference of what's getting paid off to expenses, what's going inside, and whatever percentage increase is getting credited to this cash value account. So you have certain companies out there, like whole life companies, whole life insurance policies, give you a fixed type interest rate known as a dividend rate based upon their contracts. A universal life is set up, they give their credit interest is based upon interest rates. So interest rates are at all-time lows right now, and that is why universal life policies are not attractive, because they're paying such low rates of return. But an individual could still have growth within their cash value if they have a universal life policy, or a whole life insurance is with a fixed was with a dividend rate. You also have variable universal life, which has the interest credit, which can be positive or can be negative because it's tied to mutual funds. So depending upon how that mutual fund performance would determine whether or not that credit is positive or negative to that cash value. Or then you have my most favorite type of cash value plan, which is known as an index universal life, which goes by an indexing strategy that allows your account to receive a credit whenever the market goes up or receive 0% whenever the market goes down. So, and this is shown to be very favorable regarding flexibility and regarding max cash value accumulation, and has been very popular within these past 10 years. So this cash value, once again, is going to grow by whatever that net amount of difference is between the expenses are and whatever the premiums are paid in. That's one way on how that money is getting paid into the cash value. And then on top of it is how high of a rate of return, how high is that interest credit that could also credit on top of that major bucket. So what individuals set up, or when you have life insurance agents or advisors, typically they set up these plans where you have majority of these expenses are taking up majority of the plan, and you have that very small portion are going set up in the cash value. Well, what Ed Slott was saying, and this is something that we deal with on a daily basis with our company, is how exactly can we leverage the cash value plans where instead of it set up with majority of it going to the expenses, we have a small portion going to the expenses and a large portion going into the cash value, so that we could set up these plans where you're still going to receive a death benefit, but the death benefit is going to be secondary to the major goal of having that max cash value. And this is something that a lot of companies have started gravitating towards and really understanding these expense components to say, okay, what is your client interested in? Is he interested mainly in a max death benefit plan? Or is he interested mainly in a max cash value plan? And what they do is they set up these policies so that majority of your dollars, if you're placing dollars on a monthly basis or an annual basis, majority of that plan is going into that cash value so that we're having the smallest amount of expenses possible, the maximum amount of cash value, so that now your bucket is increasing a lot faster and that interest rate is still being tacked onto that account year by year by year. The problem lies in that you have majority of agents that sell cash value life insurance plans that even try to tell the individual that's purchasing them, tell them all these great benefits about cash value, but what they're doing is they're making all those fees, all those expenses as high as possible. Reason being is because when those expenses are as high as possible, the agent commissions are also going to be as high as possible. So that's the incentive for the agent to go and set up the plan that way. Now, if you're going and you're making sure that everything's set up where you're doing max cash value and the smallest amount of expenses, well, what we're doing here is we're reducing that death benefit. So if you have the bad plan, you understand that you're probably going to have a maxed out death benefit. You're expecting to have all these great rates of return because that advisor showed you some unbelievable illustration. But when push comes to shove, after you're in this policy for a couple of years, you're starting to realize, what the heck? I have no growth in my cash value. There's nothing that the advisor was telling me. And then by that time, that advisor is most likely out of the business or is not taking your phone calls. So the way that you have to make sure that this is set up is you just have to understand the different costs that are associated with this death benefit, and then also what are the correct carriers, depending upon your age, depending upon the amount of money that you're looking to place into this plan to accumulate, and then also which carriers give you the most favorable distribution benefits as well. What do I mean by that? Well, we understand that cash value is a very good thing, and when you accentuate this cash value, it allows you to have tax-free growth, meaning that anytime that money goes into that cash value, and anytime that cash value gets credited with that specific rate, that specific interest rate, that's a positive. Well, the government is not going to be taxing that money because it's still under the house of life insurance. So the growth within that, you have to make sure that there is going to be some death benefit there. But how can we make sure that that death benefit is going to be as small as possible so that we're having the max amount of cash value accumulation? We're able to, after this money has been accumulating after years and years and years, when you're ready to take this money out, you're not subject to 59.5 rules like traditional retirement accounts, like an IRA or a 401k. You cannot touch your money with IRAs or 401ks before the age of 59.5. If you do, you're going to be heavily penalized, and it's also going to result in full taxation. With these types of accounts, you could take out the money tax-free, and also it's not going to be subject to 59.5 rules. So if we understand that those are the two main benefits of cash value, how do we set up this plan the right way? And one of the things that we do is we say, okay, well, depending upon how much money you want to place in, every single month, every single year, whatever, is based upon your specific budget, there's no max contribution that you could place into this plan. So if somebody is making $500,000 and they don't want to only max out their 401k of $17,500 and they want to go and put $30,000 into this plan, they could do that. There's no max contribution limit with these types of accounts. So in that specific scenario, let's just keep it easy. Let's just say that somebody wants to put in $10,000 per year into a plan. Well, rather than go and say what the typical advisor is going to do is say, okay, well, based upon your death benefit analysis, we want to make sure that that's going to be $2 million of death benefit, every single year, but you're also still going to have a cash value growth. No, that's complete bogus. If you're looking to utilize $10,000 or whatever that amount is every single month, every single year, you want to make sure that this money is going to be accentuated the best way possible. So the dollars that are going in, the plan is being set up where we still have a death benefit, because you need to have a death benefit to still leverage all those good IRS tax rules, such as IRS 7702 and 72E. You still have to make sure that there's a death benefit there, that we're sufficing all those expenses, but we're making sure that those expenses are as small as possible so that every dollar or majority of the dollars could be going to that cash value as most as possible. Understand with these types of contracts, they're front-end loaded, meaning that majority of your expenses, majority of your fees are going to be within the first 10 years. After that, you're going to have insane amount of max cash value accumulation that's being set up. when after, let's say, X amount of years that you say, okay, I want to go place this in there, put $10,000 per year for the next 20 years. We understand that's $200,000. Well, maybe at that point in time, the cash value has grown to $1,000,000. So you put in 200,000 because of the power of compound interest, because of all that tax-free growth that was in there. Now you have a cash value that's sitting at $1,000,000 and maybe a death benefit that has now grown to $1.5 million. So when it comes to this time, individuals say, wow, this is amazing. My cash value looks so good. Well, if you don't know how to take this money out the right way, it's going to be completely meaningless because you're not going to be able to receive it in a tax-free manner if you're going with an agent or if you're going with an agency that is not explaining how to properly set this up, or you're going into a company's contract that does not give you favorable options to take this money out. So you could take this money out by the form of a loans, and you have different types of loan provisions. You could take it out in certain withdrawals, but that's where it gets very specific. And this is something that Ed Slott hones in on, of saying, listen, yes, you could accumulate this tax-free, you could take this money out tax-free, but you have to go with a good agency. And this is one of the things that we deal with on a daily basis. We have an entire cash value life insurance department set up. Majority of the contracts we recommend is with index universal life plans. It's just because it gives you the best option for flexibility. If you're accumulating your policy, and let's say the market keeps crashing and things are going really bad, you could lower your death benefit to make sure that you have even lower expenses. So you can kind of play it, and you have that flexibility to play it 1 year, from the next. To always make sure that that cash value is accentuated best way possible. One of the things is, you have 300 plus different types of contracts set up, dependent upon your state, dependent upon your age, dependent upon your maximum cash value goal. Out of these 300 plus contracts, majority of the times, only 5 to 10 of them are really good for cash value maximization plans. And that's really sad when you think about it, because rather than going to a seminar or going to an advisor up the street that could only sell one product, one company, this is the power that we have with our agency, is to sift through all the carriers, all the contracts, to make sure, okay, which are the contracts that allow us to reduce those expenses? Which are the contracts that allow you to have that max cash value growth, that allow you to have that max income at that later date and time whenever you deem that you want to retire? And that money could come out in a tax-free way. So, by watching this video, if any of this sounds interesting to you and you really want to see and you really want to deal with an expert that knows how to, set up these things, please give us a call. It's 1-800-566-1002. You'd be dealing with a specialist. That specialist is going to ask you a slew of questions because, at the end of the day, everything could sound really good, but if it's not for your best interest, we will never recommend this type of plan, for your specific situation. We only are going to give you education and literature pieces specific to your exact criteria, specific to your exact mindset, to make sure that you're not throwing money down the drain, and you're not throwing money towards insurance, towards expenses, and you're trying to leverage that maximization, that cash value maximization, the best way possible. That's the only way that these products work. If you set them up the wrong way, you could be in this product for 12 years, 15 years, expecting one result and have an entirely different outcome. So the main things when giving us a call is you're going to become educated. You're going to understand the basic components of cash value plans, exactly why we're setting up company XYZ as opposed to company ABC, for your specific plan. And this is why we have a lot of national recognition. Depending upon your area, that's going to determine which contracts are going to be offered in your state. And from there, it's just about playing through the sifting game. We have something that no other financial agency has. It's called the Retire Sharp Planning System, where we go through on average, over 1,200 different scenarios and products before we give our top 3 recommendations on your ultimate results. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had complaints. It's because of our methodical process. We deal with these types of cash value maximization plans that Ed Slott talks about, in a lot of his videos and a lot of his seminars, a lot of his content. I agree with it. I have my own personal money in these cash value plans for my retirement because of all those different great tax benefits that you can receive. So please feel free to give us a call at any time. Understand we are not tax advisors. We set up a couple of different insurance-based products. We utilize different retirement income strategies on a very safe, conservative mindset. So this is my little disclaimer for it. We are not tax advisors, but you could also look into this and kind of view some of the different tax options. We'll give you literature pieces that help that correlate exactly to all the information that we are talking about. So feel free to give us a call at any time, and we look forward to helping you out. Thanks, guys.